I got a call from Sam Bankman-Fried.
Sam Bankman-Fried.
Sam Bankman-Fried, FTX founder, Sam Bankman-Fried.
He was doing this crazy thing over in Hong Kong having to do with crypto. One of the things that excited me so much about my short experience at FTX US is getting to see what it looks like when an entire industry from scratch is able to move as fast as possible, and to take that ethos and bring that back to traditional finance. So instead of doing perpetuals on things like Bitcoin or Ether, we're doing perpetuals on precious metals, on single stocks. Get the same kind of exposure. And most importantly, they don't have to deal with the operational risk and cost of having to roll futures all the time. In order for anything in finance to grow, it needs to be heavily regulated. Here are two trends I think we're going to see continue over these 3 to 5 years. On one side, it will be regulated, traditional finance related. And on the other side will be like the degenerate gambling, high risk, and these will split farther and farther and farther apart over time. The second trend is
what made you say yes to FTX in the first place? And what about Architect after that?
I got a call from my former colleague, Sam Bankman-Fried, who I had known from Jane Street. And he was doing this crazy thing over in Hong Kong having to do with crypto. And I had some experience with crypto, having helped build a lot of the early systems at Jane Street when they were starting their crypto arbitrage desk in 2017. But I had never kind of worked on the side, for example, of an exchange before, and had a lot to learn. But I had been following the space and was really excited about it. And when the opportunity came knocking, I decided to take the risk and go. And at the time, the entirety of the FTX business was in Hong Kong. It was largely unregulated, and it was a bit of the Wild West. And so the company at the time had decided that the biggest opportunity was to move into the regulated space, to kind of move more into the TradFi space and build an office, build a company in the US that tried to, walk through the front door in terms of getting regulatory licenses that were needed. And so that's what I did. And that's what I decided to work on for, the following year.
How difficult was it when you started Architect, and what did you gain from the experience that you had when you were heading FTX?
So when I was running FTX US, we did two things on the regulatory side that were really exciting. So the first was that we built a broker-dealer from scratch, the broker-dealer license under the SEC and FINRA. Having stablecoins as a collateral option, we think is going to be absolutely determinative to our success. That's one trend I think we'll just continue to see, is to be able to trade. And we built that with the goal in mind of being able to add stock trading and options trading to the FTX US, crypto trading app. We were sort of, ahead of ourselves there, and in having kind of the all-in-one app. You could even use USDC at the time to be able to, and they'll start to, not have anything to do with each other, and people will make choices of where they want to trade. So of having to go through the process of, applying for a broker-dealer license and setting up that entity and setting up all the required, compliance procedures and all of the kind of regulatory oversight and risk management was an incredible experience. And then the second thing that we did was we had acquired an exchange and a clearinghouse called LedgerX. And LedgerX was one of the few companies in the entirety of the United States that had both an exchange license under the CFTC being the Commodity Futures Trading Commission that oversees all of commodity futures. That includes things like stock index futures and energy futures, and also crypto futures in the US. We had acquired this exchange and clearinghouse, which would have given us the ability to basically launch what were previously kind of offshore, unregulated futures products onshore in the US in a regulated fashion. And getting the chance to understand that application process, to meet with the staff at these regulatory agencies, was truly invaluable. And so that really helped set the stage for when I was starting Architect about, one, the fact that we definitely wanted to be regulated and do this right from the beginning. Number two, we had the experience and the know-how to be able to do it, having gone through that experience with FTX US.
The decision to be regulated right from the get-go, does that come from the fact that you saw certain things with FTX? So I'm just curious about the form in which you are launching, or you have launched Architect. How has that culminated?
Yeah, it's really both. But to really hone in on that second point, so Architect, we have an exchange now called AX. And AX is the first centralized and regulated exchange for perpetual futures on non-crypto asset classes, on traditional asset classes. So instead of doing perpetuals on things like Bitcoin or Ether, we're doing perpetuals on foreign currencies for like the Indian rupee, the Brazilian real, the Mexican peso. We're doing perpetuals on precious metals like gold, silver, platinum, palladium. We're doing perpetuals on single stocks like Apple, Tesla. We have plans to do perpetuals on stock indexes, on commodities, on energy, on weather, on compute power. It was so critical for us to be regulated from the beginning and to differentiate ourselves from the decentralized exchanges, because if you look at the traditional futures market, it is anywhere from 100 to 1,000 times larger of a market than the crypto futures market. And if you ask yourself, who are the participants in those markets? Of course, there is retail participation, but it is by volume, 95 to 99% institutions. These are macro hedge funds. These are pension funds, sovereign wealth funds, sovereign governments, insurance and reinsurance companies, and large banks. And so because of these, the market itself is dominated by these large institutional participants. We needed to become a venue where those large institutional participants could actually participate. And we are still way too early in the space of the kind of DeFi universe for an institution like a big bank or a sovereign wealth fund to be able to onboard in a decentralized manner without KYC, without centralized risk management, without risk controls. And that's why we needed to be regulated from the very beginning.
The easiest use case that people talk about when it comes to stablecoins is they'll be used for remittances and stuff like that, right? Payments essentially comes as the first use case, but you can take that and create various kinds of products on top, right? Is that what was necessary for something like Architect to be created?
Yeah, it's a very interesting question because so in the traditional futures world, especially in the US, if you want to be able to trade a future, you obviously have to post margin, some kind of collateral required for margin. And in the US, there's a variety of things that you can post for collateral. There's, of course, US dollars, but sometimes you can also post US treasuries. Sometimes you can post certain kinds of other securities or even other currencies. But you can't currently post stable coins. Actually, there's a very, very recent initiative in the US, spearheaded by the CFTC to start a pilot to allow people to post stable coins for collateral, but that really hasn't happened yet. When we started the exchange, we of course wanted to make sure we were hooked up to like the traditional financial money movement system, like FedWire and SEPA and SWIFT, such that people could send in actual fiat currencies to top up their accounts for this. But we also thought it was critical to get a second license out of our, in our regulatory jurisdiction in Bermuda to be able to take stable coins as collateral too. Because we understood a few things. One, it is so much easier and so much cheaper for someone in a country like Hong Kong or anywhere in the APAC region or anywhere in the Middle East region to be able to send us stable coins than to get us dollars. We talked to one customer and we asked them, so hypothetically when we launch our exchange, you can maybe send in dollars, you can send in USDC. Which one would you rather do? And they said, well, if I send you USD, it's going to take around 1 week from my bank. But if I send you USDC, it will get there in around 10 seconds. And then the second, of course, is a critical aspect of stable coins over USD is that they can be sent back and forth at nighttime and on weekends. And if you want to organize a 24/7 perpetual market, which is a big advantage over what we're doing over the traditional financial futures markets, you need stable coins. It's sort of a must-have. And so I think I agree with you and your thesis completely, which is that even though it's not technically necessary to run this exchange, having stable coins as a collateral option, we think is going to be absolutely determinative to our success.
In terms of the product itself, right? The product and who the customer is, how do you make them switch from wherever they are trading right now, the CMEs of the world, to Architect?
If you start with the market makers, the arbitrageurs, the ones who typically establish the liquidity in order books at first, it's a no-brainer for them because obviously they can trade as much as possible and everywhere as possible. And they are doing things like using the price of CME futures to compute a relative fair value to market maker around on our exchange for perpetuals. And then they're going to be trading one off the other. So for example, trading CME gold futures versus Architect gold perpetuals at the same time. If we then move on to like who are the next traders, there's a mix of players here, some of whom, of course, have existing, kind of foothold into the traditional financial system, and they're trading futures on places like CME or ICE. And for them, the key is to dig into what is it that they're doing with their futures. Very rarely are customers of futures exchanges taking delivery of the underlying commodity. They're not buying cocoa futures to take delivery of, cocoa to create chocolate bars. They're usually trying to hedge out the exposure in a financial sense or speculate on a particular asset in the financial sense only. And so they're doing the very cumbersome thing every month or every quarter of rolling futures the next month, the next month, or the next month, and dealing with the basis risk of the futures over the underlying spot, given that this is at some point in the future. And so for them, for a lot of them, it's a pretty easy thing to see that they can do get the same kind of exposure, but they can often get better leverage. They can trade 24/7. They can, use stablecoins if it's easier to get money in and out. And most importantly, they don't have to deal with the operational risk and cost of having to roll futures all the time. And finally, I'll say two more things about customers. One is that increasingly there are crypto native traders and trading firms that want to branch out into traditional assets. And for them, perpetuals are the vehicle. They don't want to trade regular futures. They don't want to go back to that idea. They understand perps. It makes the most sense to them. They know how to price them. It's a superior product. So of course they'll come and want to trade those kinds of products on our exchange versus the existing ones. And finally, you'd be surprised how few institutions globally have access to places like, the CME, ICE, CBOE in the US, even though they're the largest exchanges in the world. It can be quite difficult for someone in any one of the 189 countries outside the US to be able to get access. And so having a very easy web-based direct access, no intermediaries, 24/7 exchange powered by stablecoins actually really enable some of these folks to be able to trade these products that they couldn't before.
I didn't know that. I thought, most of the institutions should be able to trade these things very easily.
Yeah, you'd be surprised, especially if you're in a country that's deemed, high risk from a KYC perspective.
What would be the TAM of these companies like combined?
Okay, one of the largest class of potential customers for us is CFD brokers. So CFDs, contracts for difference, they are a derivative product that allows people to trade, for example, a stock or gold as a swap in which you're trading with a particular broker. And this is a large way in which kind of the retail market trades and gets access to these kinds of commodities or stocks outside the US, is that they trade with CFD brokerages. That is a multi-trillion-dollar business, total across all CFD brokers. One of the difficult things as a CFD broker is that if you're taking the other side of these trades, you're naturally going to end up with exposure to whatever that asset is. So let's say on a given day, the retail customers are net long gold. Well, all of a sudden that brokerage is net short gold, and they need to hedge that short exposure maybe by going out and trying to buy gold or buy gold futures somewhere. And so the idea that maybe every single one of these CFD brokers everywhere from South Africa to Dubai to Luxembourg would be able to hedge that exposure easily by trading gold perpetuals on AX. I mean, every single one of those brokerages could be a customer of ours.
Given that, why is it that this kind of perpetual futures are not prominent in traditional finance?
It's an interesting history. So the perpetual as a concept was written down in sort of an academic paper in the 90s in the US. And it existed in certain forms as over-the-counter derivatives that were mostly, being offered by banks to very large institutions. But it was really cryptocurrency exchanges in like 2012, 2013 that first made an exchange traded product in the form of a perpetual that was available for everyone to trade. And of course, the idea there being that, again, they wanted to give leveraged exposure to Bitcoin, but Bitcoin wasn't a deliverable commodity tied to a particular date. They just wanted something that would like forever expose you to sort of the forward rate of Bitcoin at a leveraged amount. And so that crypto really is the asset class that made perpetuals an actual understood vehicle. Prior to that, no one knew what a perpetual was. And it really took probably the better part of 5-6 years for perpetuals to really catch on in a huge way in crypto, such that everyone knew them, understood them, and traded them, and then ended up with exchanges like Binance and FTX and OKX and Bybit and all these exchanges that have perpetuals now. Prior to that, there's been issues in basically every jurisdiction around whether perpetuals have been allowed as a class that people can trade. Because even, for example, in the US, regulation in the US around futures primarily contemplates a future as something that has an expiration date. If it doesn't have an expiration date, that makes it something else. Maybe it makes it a swap, and swaps have very different rules in the US than futures. And so as a result, people have not tried to kind of push the envelope and try to get these approved by the regulatory bodies and get them added to the rule set and be able to launch. But there's a second important point here of why this has not taken off a lot, in traditional finance, which is that you have the classic innovator's dilemma. The incumbent exchanges make a lot of money off of people rolling futures every month and every quarter. And if perpetuals are a superior vehicle, if they were to launch them, they might eat into their own revenues when they don't need to. A lot of these exchanges have dominant market share in traditional finance. And so they haven't necessarily tried to create perpetual derivatives to replace traditional expiring futures.
So I just wonder why someone hasn't created this, because it's a superior vehicle and reduces the costs for the trader.
The traditional financial system in futures is one of the most critical industries in the world. It's one of the largest industries in the world, and it's one of the slowest moving industries in the world. So in 2008, post-financial crisis, the Dodd-Frank legislation created this notion of a regulated swaps facility called a swap execution facility. It's now been almost 20 years since that legislation, and there are fewer than 10 operating swap execution facilities in the US. I think the number is even smaller than that. And so again, the industry moves very slowly. How many crypto exchanges rolled out perpetuals, including DeFi exchanges? Can you guess the number?
Has to be around 50 or more.
It's probably close to 100 at this point.
Yeah.
I mean, it's so large. And so one of the things that excited me so much about kind of my short experience at FTX US, regardless of what happened there, is getting to see what it looks like when an entire industry from scratch is able to move as fast as possible, and what it means to really push the frontier of market structure. And we as a company really wanted to take that ethos and bring that back to traditional finance and say, we're going to start from scratch too. We're going to be regulated, which is going to be hard. It's going to take us a year and a half to get all the licenses we need, but we're going to move at the same pace after that digital assets move, and try to really kind of bring something new to bear. And that's what I think is differentiates us from what's going on previously.
If I'm correct, didn't FTX launch interest rate swaps?
Interest rate swaps, I don't think so, but it did have some. There was a famous story where there was one day where the price of lumber was going crazy, and on the same day that people were talking about it on Twitter, almost as a proof of concept, a lumber future or a lumber perpetual got launched, and that was sort of early for its time. But I think that was like the right idea, which is that you should have a platform by which you can very easily launch any kind of cash settled derivative as long as you have an index price. And so that's exactly what we built as well.
In your time when you were at FTX and post that, has that changed how you think of trust, transparency, risk, and stuff like that?
Yeah, I mean, look, my entire career had been in the most heavily regulated space, right? Of being a, prop trading firm, of trading everywhere from NASDAQ to CME to Eurex to Osaka derivatives, trading everything from, ETFs to futures to options and fixed income products. And so, seeing this world of kind of, unregulated futures products, which is what the world was at the time, uh, it was crazy. And again, it was great to see what could be possible in terms of being able to innovate very quickly. But it was always my understanding that in order for digital assets and digital asset futures to grow, it needed to be kind of brought into the regulated space. It needed to be connected back to the institutional, traditional financial system in some way. One of the best examples of this is like, look how much crypto as an industry has grown since the launch of spot ETFs in the US. And ETF is a very, very old concept. These, whether it's a 34 or 40 Act funds are, they are such an old concept in the US. And yet it's that traditional securities product that has enabled the absolutely explosive growth of digital asset participation in the US. And so, yes, it's important to be able to make innovative products and to not be held back by regulation, but we have to be realistic that in order for anything in finance to grow to any legitimate size, it needs to somehow connect back to the banks and the pension funds and the retirement funds. And in order for it to do that, it needs to be heavily regulated. So that's what it was. Our learning from that whole experience was that we needed to be regulated from the very beginning and as much as possible.
How do you marry that with speed?
I think, the key is to understand, you have to first of all figure out what's the right license that you need to get. What is the specific thing that you're going for? And often that process of getting an exchange license is very cumbersome and hard and costs a lot of money and time and resources. But then often once you've done the work, if you are, very explicit with how you've spelled out your mandate as an exchange, like here are the kinds of products I'm going to list, then often, regulatory bodies are flexible and they will work with you to say, okay, well, you can launch products that look like this, without coming back to us for an application every single time. And so, that's why it's so important to have great dialogue with your regulators so that they will trust you and understand and give you the kind of the ability to be able to innovate quickly and to launch new kinds of products, while still staying completely within the mandate and within the rules.
Initially, I mentioned that it's in a white space where, I don't think there were any players in this market when you started off. You have exchanges like Lighter and Hyperliquid that increasingly offer things like gold perps or NASDAQ 100. So how do you navigate all of this at Architect?
Well, I'll take those each kind of one at a time.
Yeah.
So the DEXs, the decentralized exchanges like Hyperliquid and Lighter, I just view as complementary products. I just don't think we're competing for the same kinds of customers. Again, we're trying to go up market as much as possible to the largest institutions in the world. In fact, right now our exchange is open only to institutions. We eventually will open to individuals, but right now we are only open to institutions. And that's just a completely different customer set than the kinds of people who are connecting wallets on Arbitrum and, sending into like non-KYC exchanges. And so, we're pretty heavily differentiated there. We're also differentiated from them on the kind of risk management layer where we are, for example, very methodically choosing the maximum leverage per product, very much tied to the underlying product's volatility to ensure that there are as few liquidation events as possible. That's not our business model. So that's sort of the first, set of potential, competitors you talk about. I also view something like NASDAQ or NYSE going 24/7 or even tokenized as completely complementary to what we're doing. So in order for market makers to be able to successfully market make in, let's say, an Apple stock perpetual on AX, they really do need an underlying price that they can trust 24/7, and they need some place to ideally hedge their perpetuals 24/7. And so the fact that there might be a market where they can trade stocks 24/7 is only going to help the growth of our perpetual market. People might not realize this, but there are already some exchanges in the US that allow you to trade like 24/5-ish. And there are a few that are coming online that are going to be like, 24/7, including NASDAQ and NYSE's eventual plans. Still, there are limitations when trading actual cash equities, actual stocks, that make them, still not as good in certain circumstances as a perpetual future. So for example, if you want to sell a stock short in the US, you have to first get a borrow or a locate of that stock, meaning you have to borrow from a prime broker or a bank shares of the stock so you can sell it short. Well, first of all, access to that borrow market can be very difficult for the average person. Sure, if you're Citadel or Jane Street, you have access to the best borrow rates and the best borrows available. But if you're just sort of a random Joe customer, you might not have access to it at all. The second is there might not be any shares to locate. Some stock might not be able to be shorted. And so, it might either, trade at a premium, or so if you want to short, you have to really pay a huge interest rate to do it. With a perpetual, there's no limitations on that. It's a derivative. So you can go long and short with ease. And so it will allow people to be able to go long and short, without needing to worry about this borrow issue. The second is that in the SEC regulations limit the amount of leverage that you can have on stocks or portfolio stocks, depending on a variety of characteristics of what the customer is. And so perpetuals, again, offer kind of a larger range of potential like leverage opportunities for customers. And then, of course, there's the ability for us to, in the future, cross-margin stock perpetuals with gold perpetuals and, Indian rupee perpetuals and, crude oil perpetuals all in one exchange, which might not be possible in a stock exchange. So I'm really excited about the 24/7 developments for NYSE and NASDAQ. I think they're only going to help what we're trying to do. And then, of course, the other legacy exchanges, again, we won't get into it here, but there's a variety of reasons why listing perpetuals in the US is not clearly spelled out as something that is allowed to be done under the regulation. That is part of why we started our exchange by being regulated in Bermuda versus the US, although we do have desire eventually to get into the US.
Can you tell us a little bit more about what happened on October 10th, where I think more than $19 billion were liquidated, and what exactly happened that led to such a big liquidation, and how that could have been avoided?
Let's pause for a second and go think about how a traditional futures exchange works in terms of its risk waterfall. So number one, every traditional exchange from NASDAQ to CME has these notions of price bands where basically they try to prevent flash crashes where, if let's say there's a bug in the matching engine, or if the liquidity just temporarily falls away, the last thing they want is a stock going from 100 to a penny and then back to 99. Such that when it goes to a penny, a bunch of people get completely wiped out. And so what they'll have are these circuit breakers, price bands, volatility halts, where if it moves more than X% from some benchmark or a previous close, the market pauses for a second. It gives everyone a chance to take a breath and reestablish liquidity and make sure that the market is either has actually moved down, or if it's been unfair, they can move back to the right place. So that's something that we do that, generally speaking, decentralized exchanges don't have. The second is that traditional exchanges don't generally do auto liquidation. In fact, the exchanges themselves don't do it at all. It's all the intermediaries that do it, where if someone is starting to breach their maintenance margin levels, they get a call, an actual call or an email, and say, hey, within 24 hours, you need to top up your account, or else we're going to have to take down your positions. It's rare, and only in some of the most retail kind of brokerages in the US does someone actually get auto liquidated in real time. A lot of that's sort of end of day batch processing, which it has its pros and cons, but it definitely results in fewer kind of unfair liquidations. The third is that in traditional exchanges, there's this notion of a default fund or an insurance fund where either the exchange itself or the participants will put up capital to serve as the backstop, to serve as the buffer layer to make whole the whole system in case one account gets blown out and there's not enough margin to cover their account. in a lot of the decentralized exchanges, they do this thing called ADL, or automatic deleveraging. In the traditional financial world, that's called tear ups, where you tear up the position. You kind of didn't happen. And that is often the very, very, very last resort in a traditional exchange. Whereas for a lot of dexes, it's the first thing they do, is they cancel all the winning positions in order to make whole the ones that have lost. And so what happens here is on October 10th, there was a crazy move in one benchmark price from one exchange. Too many exchanges depended on that one benchmark exchange. And the second that this thing moved, instead of like it getting paused or bad points getting thrown out or it averaging out or taking a breath, it just immediately went in market orders, tons of different accounts, and sold them off. And that caused a cascade. And so again, I love the fact that in the crypto world, we have tried to create market structure that's on the bleeding edge and very much kind of reinvented the traditional financial system from scratch in a way that's hopefully better. At the same time, you find that people are relearning the risk management learnings of the traditional world that have been hard, like baked into exchanges for decades from scratch. I think, I think a lot of exchange operators in the crypto space would do well to take a look at how these exchanges are operated in the US, like NASDAQ and CME, learn those rules and try to figure out which one should apply so that kind of thing doesn't happen again. But that event on October 10th definitely eroded trust in DEXs and in a lot of exchanges in a way that I think is irreparable.
How do you approach risk management at Architect?
We basically do all of the above on our exchange. I mean, we have price bands, we have funding band limits. For our institutional customers right now, there isn't automatic liquidation. We just do traditional margin calls, and we give them the opportunity to post and to top up their accounts. We set margin levels carefully based on volatility. So something with a vol of 10 is going to have a lot greater margin, so greater leverage ability than something that has a vol of 40. And so we're careful about setting margin limits per product. We have the default waterfall where we've put up some of our own capital to serve as the backstop in case an account does go underwater. We're planning to allow other participants to be able to post into that insurance fund and earn some kind of return on that insurance fund, but nevertheless they would have the risk of having to backstop customers if a customer were to go under. And sort of the ADL procedure is at the very, very bottom of all of this. I would say the other thing that we do as well is that our products are all based on like trusted third-party benchmarks. So we are not computing our own rate for the euro, for our euro perpetual. We are using the official 4 p.m. closing rates from Reuters, Refinitiv, London Stock Exchange Group. We're not using our own prices for Apple. We're using the official closing prices from NASDAQ. We're not using our own prices for metals, same thing. And I think that using trusted, non-manipulable third-party benchmarks is what kind of adds integrity to the product's pricing.
What happens when the price moves a lot between close and open?
So yeah, when the price moves a lot, basically the market doesn't allow orders to go in sort of below that price, let's say, for some period of time. And so what that means is, if it truly did move, more than the 10% in a day that was expected, which might be like a 4 sigma move or something like that. It might mean that there's a bit of dislocation between our products and somewhere else for a period of time. But our expectation is that in 99 times out of 100 cases, something like a 10% move within a couple hours is probably because of bad liquidity or because of an exchange operational issue, and not because of like an actual move of that magnitude within a day. When's the last time that the euro moved 10% in a day?
In the context of crypto, if you are stopping trading, that doesn't mean everyone else is. Someone somewhere will keep the trading on, and you probably miss out on price discovery at that time. How do you resolve that?
I don't necessarily think the exchanges have to all be coordinated. I think, if you're trading on an exchange, would you rather, miss out on 5 minutes of trading or risk during those 5 minutes having your accounts blown out? I think it's all a trade-off. And I think if people would prefer to there be something that they guarantee will never be stopped, then they can trade on a different exchange, and that's sort of the differentiating factor for them, and that's totally fine. I think more choices for exchanges are good. And if they have different rule sets, then they will attract different kinds of customers. I think one interesting example of this is in the US, when people think about like Apple stock, they think about, the NASDAQ stock exchange. But in reality, there are, I think, 16 different national stock exchanges where you can trade Apple. And then there's probably 60 different like dark pools or alternative trading systems where people can trade. There's lots of different venues, and they all have different rules. So for example, there are some exchanges where, the providing fee is lower than the taker fee. In other words, they try to incentivize liquidity provision versus the taking. And then there are some exchanges that it's the complete reverse, where the takers get the rebates and the makers have to charge. And they're just two different kinds of exchanges, and they attract different kinds of participants, and it's nice to have the variety. And so I have no problem with our exchange having different rule sets than a different one and letting customers choose. I think there might be reasons why a retail customer would prefer it never going down, it never stopping, and just dealing with the price and the volatility risk. And there are probably institutions that say, I refuse to get liquidated ever. And, I don't care if this exchange only runs 2 hours a day. I need to make sure that the risk management's there.
Yeah, I think it's a perspective, right? I mean, when you don't have the option of trading, the bias is that, oh, I wish I could have longed it at this price. And that is exactly what I would have done.
And moreover, during a time where a market's crashing 20% on one exchange, what do you think the underlying technology is doing at that time? Even if you sent an order during that time period, how likely is it to actually get filled? My guess is, the exchanges that were flash crashing on that day were getting millions of messages sent into their matching engine, and they were completely backed up. So there's truly no guarantee that during that time you would have gotten filled anywhere.
Is there a difference to how that works on EX?
Yeah, so there's some... the funding rate mechanism with perpetuals is the thing that keeps the perpetuals in line with the underlying. There are some DEXs that create funding rates that are actually based on the order book of the perpetual itself. And if you do that, then that doesn't necessarily tie the perpetual to the underlying. It ties the perpetual to itself. So we are very deliberate in that our funding rates are entirely based on the difference between the current perp price and some trusted third-party benchmark. So let's say let's take the Indian rupee for example. So we might launch perpetual in Indian rupee, where every day at 4 p.m. we'll take a snapshot of where the perpetual is trading, the order book prices, the most recent trade prices, and then we'll take a snapshot of the LSEG Reuters Refinitiv 4 p.m. closing rate in the UK for INR. And whatever that difference is, if it's positive, then longs will owe the shorts, and if it's negative, the shorts will owe the longs. And it's that mechanism that keeps the perpetual in line with the underlying and basically makes the perpetual approximate like a one-day forward that automatically rolls and whatever that rate is. If that funding rate were to be excessively large, then an arbitrageur could buy Indian rupee or buy NDFs on the Indian rupee and sell the perpetual or the other way around and be able to profit from like a perfectly hedged position and that large funding rate that they would either earn or give away.
So how do you keep the momentum going on while all of that is happening?
Yeah, well, look, besides getting the licenses, there are a lot of things to build to create an exchange. There's the matching engine, there's the risk layer, there's the user interfaces, various kinds of compliance and oversight tools, getting all of the market data for usage in the perpetual funding rate settlements. And so there's a tremendous amount of work to do and a lot of testing to do. And so we certainly have kept ourselves busy. It definitely, it's not for the faint of heart, because you might be looking around you and seeing decentralized exchanges that are unregulated moving forward with products and thinking like, okay, if we did it the unregulated way, we could be live already. And I think the important thing is to stay disciplined and say, like, when we launch our exchange, we will catch up, and we'll catch up fast, and we'll win by having, the properly regulated, properly administered exchange, even if we weren't the first to market with a, stock perpetual. We were luckily very kind of ahead of the curve in thinking even 2 years ago that this is a thing that was going to be big, such that, if we were to start applying for licenses now, I think we would have been way too late.
Right.
And so
Right.
we're in a good positioning now as a result.
What are you doing right now to make sure that, liquidity is there when market makers want to come, and the other way around as well?
So a lot of exchanges, of course, will have their own market maker as a way of sort of solving that side of the cold start problem. We were very deliberate and strict with ourselves that we were not ever going to have our own internal market maker. So we wanted all liquidity to come from neutral third parties instead of having any possibility of conflict of interest between our exchange and our customers. And so we do the very classic thing that every exchange does, which is offer incentives for being, day one market makers, whether that's, in the form of cash or some in the form of potential like equity in the company. There's a variety of ways in which we can incentivize market makers. And that's how we solve that side of the cold start problem. And we think that's the first side to fix. Once there's reliable, deep liquidity in the order books, it's a lot easier to go out to the taker side of the world and say, look, there are these products, there's deep liquidity, you could trade today, and then get them to onboard.
Where does it touch the blockchain infrastructure part? Because it's a centralized exchange, right? Everything is happening off chain.
Sure. Yes, the only interface with blockchains is in the deposits and withdrawals of stablecoins for collateral. So we currently use Anchorage as our third-party custodian. All of the funds are held with them. So if someone wants to use USDC to be able to trade on Architect, and they send USDC to their specific customer wallet at Anchorage, and that's where the blockchain comes in. But other than that, we're completely centralized. It's all centralized infrastructure in the cloud. There might be some possibilities in the future for us to kind of hook back into blockchains for settlement of perpetuals itself, but that might be a future endeavor.
Do you think the stablecoin base right now is there to support all of that, or that base needs to be much larger than where it is right now?
I think it's large enough now, and I also think that these things would grow together. I think if we suddenly had $100 billion of open interest, and therefore you would need somewhere around 10 billion of stable coins to support it, I think people would mint stable coins to support it, and the stable coin would grow. Remember that the average, let's say, max leverage ratio for one of our products is maybe around 10x, let's say. So if there's 100 billion of open interest, that would mean we need 10 billion of stable coins. I think I can't remember how much USDC is outstanding right now, but it's somewhere in the 60 to 80 billion, I think.
Yeah.
So, there's definitely enough in circulation. And again, people would mint it if they needed it. If somehow we ended up with like $1 trillion of open interest, well, I mean, that would be a different story. But also, I think at that point, we have probably grown the entire industry by tenfold, and everyone wins.
I'm curious about who the participants are in that market.
Yes. Just a couple of days ago, we announced a really cool partnership with a company called Orn, and ORNN. And what Orn does is they create indexes for compute. So for example, an index that tracks the daily rental price of H100 NVIDIA GPUs, or an index that tracks the price of buying, a particular kind of DRAM memory. And these are, critical inputs to AI compute workloads. And so these large, AI companies that are training models and spending, tens of millions or hundreds of millions or sometimes even billions of dollars on their training and their compute, don't really have a way to hedge the price of, let's say, renting GPUs. And so, these products that we're going to make together, which are, perpetuals on compute power and compute inputs, will allow these AI companies and hardware vendors and model providers and AI companies that are consuming these models to be able to both speculate and hedge. And so we think those will be new participants of this market. Pretty much any kind of power-based input should have a derivative to let people transfer risk.
Does something like that already exist in traditional markets, or like you guys are the first to this market?
I think we will be the first to have an exchange-traded future. Orn themselves have executed swaps over the counter between two parties, and a couple of that I'm sure has happened before. And of course, there's things like long-term contracts, that you can do with a data center to be able to lock in a price. But that's different than having like an actual central order book for an exchange-traded derivative, and we think we're going to be the first.
Does the players coming together make the costs lower? What are the other reasons for them to go to an exchange?
It depends what you mean by costs lower. Does it lower the cost of the underlying commodity? Not necessarily.
No, not that.
But does it greatly decrease the slippage into getting into a contract?
Right.
Yeah. Does it increase the transparency? Yes. So I would hate, it would be really bad if every time a hedge fund wanted to hedge their market exposure by selling an S&P 500 future, if they had to go find a party and sign an ISDA agreement and do an over-the-counter swap and wait a week for the lawyers to finish the paperwork. Instead, they get to, within microseconds, get in and out of futures contracts. And so, I think, it's a matter of time before the same thing will happen in compute.
5 years from now, 3 to 5 years from now, where do you think the industry will be? And how would you speculate it changes over the next 5 years?
Here are two trends I think we're going to see continue over these 3 to 5 years. I think one is that more and more kinds of assets are going to be tradable, whether that's in the form of a token or in the form of a future or perpetual. We're going to have, markets in everything. I saw over the weekend that, tokenized Pokemon cards are up to, 120 million in volume. That's sort of a toy example, but I think that, over time, every kind of marketable asset will end up being tradable in some form or fashion, whether that's through a future, a prediction market, or a token. That's one trend I think we'll just continue to see. The second trend I think we'll continue to see is a continued bifurcation of venues. And on one side, it will be regulated, traditional finance related, institutional grade, KYC, high risk management, high regulation. And on the other side will be like the degenerate gambling, the complete high leverage, high risk, unregulated, no KYC. And these will split farther and farther and farther apart over time. And they both will exist, and they'll start to not have anything to do with each other, and people will make choices of where they want to trade. And I think we're seeing that more and more now, and it'll just continue to go that way over time.
All right. I think we are at the end. Is there anything that I have missed out on? Is there anything that you would want to add?
No. Yeah, we're just extremely excited to bring this new exchange to market. We really think that there's a generational opportunity to bring all global equities, all global commodities, all global energy, all global interest rates, all on one exchange in this perpetual vehicle that's accessible from anywhere, anytime, and with USDC or USD or fiat currencies or stablecoins of any kind. And that this will be a revolutionary concept. And so we're just thrilled to bring this to market and try to grow it as fast as we can.
Thanks a lot for spending the time. I really appreciate it.
Thank you. My pleasure.